Well, good afternoon, everyone, and welcome to the Copper Spotlight. We're glad you can join us, especially after lunch, which is always a tricky schedule period when people are starting to have the food coma set in. But we have an exciting lineup for you today. We've got two terrific speakers lined up for you who I'll introduce in just a moment. First, some of the housekeeping items that we need to remind you of. We would please ask all audience members to silence their cell phones. Also, the antitrust guidelines have been distributed around the room. We would respectfully request that you read them and keep them in mind. Basic rule of thumb is if you're in the marketplace buying and selling material, we would ask you to refrain from any forward-looking statements about pricing, either in your comments or in your questions. We'll have the two presentations, and then we'll have hopefully some time for some Q&A at the end of the session. I want to thank both our speakers very much for coming here today. We really appreciate it and looking forward to a fruitful conversation, and we certainly encourage you to participate in that conversation. Okay, that takes care of that. Certainly, it's an interesting time in the copper and copper scrap markets today. As you probably saw, LME 3-month copper official asking price was at $66.26 this morning, or just over $3 a pound. As compared to 1 year ago today, that's down from $7,516 a ton 1 year ago today. So it's off, as of this morning, exactly $890 a ton, or about 40 cents a pound from 1 year ago today. We've seen concerns about China, which we'll talk about hopefully a little bit today. Concerns about investment flows into the commodity space, which we'll definitely cover today as well. And we've seen some weakness in terms of global demand on the copper scrap front. The latest figures from the International Trade Administration and Census Bureau show that through February, copper scrap exports from the US were down 16% by volume to about 161,000 metric tons. If we look at the US exports of copper scrap to China alone by volume through February, those were down 18% as compared to the same period last year. So some challenging market issues that we're facing right now, but I think this panel is uniquely situated to provide some insights and guidance. So I'd like to start by asking Michael Turek to come to the podium. Michael is the Senior Director at the Metals Group at New Edge. Michael started his career some decades ago, we'll call it, in the physical metal arena. From there, he accumulated experience on the floor of the London Metal Exchange, subsequent to which he focused upon order flow management and transaction timing with clients for the purposes of providing price-efficient, voluminous, and confidential liquidity. He's well known for pioneering many hedge strategies with numerous major corporations. Please join me in welcoming Michael.
Thank you very much. Thank you, Joe. Thank you all for being here. Just a couple of quick logistical notes before we start. When I was here this morning watching the very interesting economist panel, I noticed that they wandered around unfettered all over the stage. I'm going to position myself behind the podium. Being as vertically challenged as I am, I feel a lot more secure here. Being a broker, you often find that people launch projectiles in your direction. So I'm very much more comfortable here. Copper, bridge too far. I'm not sure if there's any copper in bridges, but I like the title. And it suggests, I think, that copper really is at a crossroads, spanning the market divide. An unfortunate play on words, and we haven't really got past the title so far. But these are interesting times, as Joe just mentioned. I'm showing this slide because I have to. I'm not going to dwell on it. Just to mention very briefly that today our company is 50% owned by Société Générale and 50% owned by Crédit Agricole, soon to be 100% owned by Société Générale. And I think it's fair to say that we're major participants in the London Metal Exchange. I heard this quote some time ago, and I thought it was very enlightening. Some minds improve by travel, others resemble copper wire or brass, which gets narrower by going further. My own experiences have been immeasurably enhanced and enriched by Joe and his team, who have invited me to this august gathering. I'm intimidated, but also honored to share this platform with Ed, whose analytical talents in our industry are legendary. For myself, I'm more involved in trading these markets for an amalgam of industrial and financial clients at New Edge. I have more decades experience than I care to spell out today. As Joe mentioned, started in physical via the floor to helping clients to achieve appropriate and objectives in the marketplace today. I'm sure you all know that last week a combination of Harvard and MIT, this has got nothing to do with the London Metal Exchange, by the way, a combination of the two of them, and who am I to question such prestigious institutions, in looking for the origins of the Big Bang, they actually feel that they may have discovered alternative universes. Where they're not strictly up to date, I am, and I can tell you very briefly that as of a couple of hours ago, an alien spacecraft landed in the middle of the city of London. The aliens exited the spacecraft, stopped the first person they saw, said, "Excuse me, sir," if they were that polite, aliens, "Excuse me, sir, what's your IQ?" The man answered 160. They then proceeded to ask him, what does he do? And he said, well, I'm, a leading surgeon at the Royal College of Surgeons. They were very impressed, moved on to the second person, said, "Excuse me, sir, what's your IQ?" He said 150. "What do you do?" He said, "Well, I'm a Queen's Counsel barrister, a QC." They went to the third person and they said, "Excuse me, sir, what's your IQ?" And the man answered 50. And the alien said, "Aha, you must be one of those London Metal Exchange traders." You've heard that joke before? Maybe. Well, it is a recycling conference after all, so I think it's fair. The market is a living, breathing. I want to go quickly through some of the market dynamic on the way to copper, because I don't think that we can truly isolate our analysis of what has transpired and what is transpiring in the copper market without looking at some of the market dynamic and without looking at some of the participants. The market is a living, breathing macrocosm of divergent psychology and opinion. Supply and demand are definitely critical factors in this. They're critical drivers. But what about sentiment? What about perception? Who uses the terminal markets? Well, specifically, I'd like to relate my comments to where I feel more grounded, a little more secure, not that much, on the London Metal Exchange, which trades today about 80% globally of all metals that are traded on a terminal market. Obviously, we have a mixture of hedgers and investors, hedgers being those in industrial corporations who are using the markets to turn unknowns into knowns, to control revenues, to control costs. We have investors who participate in the market for capital return. I'll talk more about those in a minute. One sense is, although you might hear otherwise, but generally speaking, the trend instigators are those in the industrial arena who are functioning on the basis of their own supply and demand factors and the more macrocosmic ones that affect their particular metal. The trend followers are largely those in the arena of what we generally call funds. I'd like to break those down briefly into two. One is we have macro hedge funds, well, really into three, but macro hedge funds, I'm going to lump in some pension funds as well, who basically are taking a directional view on a particular market, largely also in accordance with fundamental drivers. We have CTAs also who are using technical models, black boxes if you like to call them that, who are studying from a scientific point of view price action and making their trade determinations accordingly. As of last week, when Michael Lewis, famed financial author, appeared on 60 Minutes and then subsequently published his book 5 minutes later, high-frequency traders have all of a sudden garnered a lot of publicity, much of it adverse. Now, I have to say that in all the elements of the market that I've discussed so far, I think they all contribute very valuable liquidity. I mean, I think that a point that is missed sometimes is that, CTAs, for instance, will be trading a breakout, the beginning of a new trend, and they'll be selling into weakness, which gives the consumers a chance to buy that weakness, and vice versa. So I think all the elements that I've mentioned really they're important components in the overall market. When it comes to high-frequency traders, some of us have been troubled for some time, and I should be a little circumspect, as there are lawyers in the room. Some of us have been troubled for some time by the fact that high-frequency traders, unlike the other type of funds that I mentioned, don't react to signals, but rather react to the actions of others. I shall leave it to those more qualified to make ultimate judgments, but I wouldn't be surprised if we don't see a lot more headlines on that subject. So now we come to copper. What has all that got to do with the price of tea in China, or copper for that matter? Copper does appear to be, it's a very crucial time, and it's a very opportune time for us to gather, because copper really appears at the moment to be standing at a crossroads. There appear to be an array of compelling, bullish factors aligned against an equally impressive array of bearish factors. Let's take an overview, review an overview of those factors and what constitutes a standoff. First of all, we'll look at the bullish argument. LME inventories have shrunk by 28%, over 100,000 tons year to date. There will be questions perhaps afterwards about where some of that metal has gone. Has it gone into less transparent warehouses? Is it being financed? Has it really gone to consumption? But nevertheless, available supply, fair to say, has decreased quite substantially. Nearby spreads, and that continued today, even when the market was down, as Joe mentioned, nearby spreads have remained in a backwardation since mid-December. Chinese copper demand rose by a stronger 11.2% in 2013, according to reliable statistics, bearing in mind that China accounts for roughly 40% of world consumption. Now, you hear a lot of talk about this, and we heard it this morning. China has set growth rates of 7.5%. It's ambitious, even 7.25% is ambitious, but we think it is achievable, and perhaps I'll have an opportunity to explain why towards the end of the presentation. Urbanization and infrastructure spending continue to boost demand. Grid spending has increased substantially, another 10% so far from the record in 2013 at the commensurate pace, of course. Global growth as a whole appears to be intensifying. It does appear as though even Europe, which has been the weak link in the chain, is exiting recession, and certainly their manufacturing data continues to improve. Global vehicle sales, very strong in the US and globally, continue to grow another 5% this year to over 72 million units. We've had some Chilean labor disputes. We've had some Chilean earthquakes. So far, none of those have impacted for any length of time either production or port facilities, but everybody's a little concerned about that. And generally speaking, the market is very short. The bearish view. After many years of hearing that mine production is actually challenged by increasing costs to reach richer veins of metal, we now hear that mine production increased 7.3% or 1.2 million tons in 2013. New projects are coming on stream in Latin America, ostensibly to fuel local growth, primarily within Chile, Peru, Mexico, and to some extent Brazil. These units coming on stream have the potential to dislocate other units into the open market, induced by higher TCs and RCs, higher physical premiums, and ongoing warehouse incentives. Largely anticipated surpluses in 2014 has been a subject of a great deal of discussion recently. I'm sure Ed will touch on it. And those surplus forecasts appear to be rising, but certainly we're hearing something around 400,000 tons for this year and almost 600,000 tons for next year. Cancelled warrants have fallen back to 48% of LME stock, from 66% at the beginning of the year, suggesting a modicum of additional availability. Very big factor in all of this of recent, and we'll see later when we study the price action in a little more detail, the recent Chinese default. Hitherto, bearing in mind that China has supported its large industrial conglomerates and banks when under financial stress. The recent default of a large industrial customer, a large corporation, highlights the systemic vulnerability to growth and the impediments potentially to growth in China. Given the scale of copper collateralization and leverage, further enforced liquidation of inventories in China could force additional supplies into the open market. Much of that metal, without going into too much detail because time is the limit, but much of that metal is being used, is being leveraged many times over, is financed largely by somewhat nebulous, in some cases, letters of credit. Now, interestingly enough, at around this time last year, when some letters of credit expired, that copper did actually exit the mainland, but at that time we had a contango prevailing on the metal exchange, and therefore that metal largely found its way to LME warehouses, largely Johor, and largely it remains in there under long-term financing arrangements, which again suggests a lack of available supply. Chinese funds are selling. What do they know that we don't? Well, it's a difficult question, but one senses again that China's playing a very delicate balancing game between skimming speculative froth, which is constituted not only in copper, but in millions of empty apartments. So they're trying to find an approach forward, which again we'll come to later, that enables them to skim the nearby speculative froth without jeopardizing long-term growth. So where do we go from here? And I hope I've given a reasonable update. The Fed, in many ways, has confused the markets. This has been going on for the last couple of years. It's been quite harrowing on occasions to witness in the marketplace that good economic data is met by a collapsing market. And the reverse correlation between the two, to be accurate, has really been formulated by the Fed themselves in terms of their tapering policy. So every time we had good economic data, everybody said, oh, well, the Fed will taper quicker, and the markets went down, and of course, vice versa. I think at this point, and it seems as though the economists on this morning's panel, were pretty comfortable with this, it's going to be, as, the economic recovery is slow and steady, so will go the tapering. The Yellen factor. I think the markets, the other reason why just a few weeks ago, the metal markets, in particular copper, which, as I said, was exacerbated by concerns over the Chinese debt structure. It was also caused by nervousness over Yellen's statement about rising interest rates. I think she's now, she was new in the job at that time and perhaps needed a little more time to reflect and to watch the markets be impacted, though the equity markets were quite resilient, really, in the face of all of this, and actually have drawn away some of the investor demand from our markets by their resiliency and their continued uptrend. But she has now made a U-turn on that statement and has conceded that the economy is far too delicate and in far too a sensitive point at this stage for interest rates to rise. Interest rates not rising, parenthetically, is an incentive, if that's the right word, for metal to remain under financing arrangements in warehouses. And we'll come back to that hopefully later, or perhaps there'll be some questions and answers. Being a dollar-denominated commodity, copper is very sensitive to movements in the currency markets, and a rising dollar would depress the price of copper. One would think that if interest rates aren't going up, in the near term at least, that the dollar shouldn't rise, although it has been a store of value to some recently, but one would think it shouldn't rise too sharply and therefore would give copper some breathing space. As I mentioned before, Europe is continuing to show improved manufacturing activity, and Draghi is being dragged into more QE to fight deflation. China. It's always the big question. You know, so many people hang so many hats on that peg, it's not surprising that the cloakroom collapses ultimately. But China is in a very different situation than, for instance, we are. They run a centralized economic authority. And one senses at this stage that they can have their cake and eat it too. And the way to do that is through stimulation. It would certainly help to maintain their well-advertised growth rates while continuing to provide relief to the debt infrastructure, which is clearly under stress and strain at this time. They say a picture tells 1,000 words. I'm not really sure if that's the case. But certainly you can see in the recent past that sharp decline. Combination, as I say, of very great concern about China and its ability to maintain its current pace of growth and the pace of growth that we've become accustomed to in the last few years. I think Yellen didn't help. Since then, we've had a little bit of a recovery, albeit that the market is down today at just above 6,600, not far from that 6,650 level that I think it was actually on the close of Thursday or Friday when I prepared this slide. I've also overlaid on it some long-term moving averages, which relate again, you know, more to the technicians in the crowd who will focus on those for turns in the price, new trends. They might look at overbought, oversold indicators as well. And certainly the market is looking a little oversold, but way away from those long-term moving averages. So again, one would suggest that if there is going to be a recovery, it's going to be slow and steady, unless it can get through those moving averages, which by the look of it are at least, you know, $100 to $200 above the current market price. So I started with bridges. I'll end with bridges. Can copper bridge the credibility chasm? I think the medium-term prospects for copper suggest that, given and assuming that the Chinese will find a way, which I think they will, because they're determined, they can streamline the process. They don't have to go through Congress and every other department in Washington to get anything done. They're not faced with that type of logjam. I think they, although some of the economists I think might disagree with this, I think that certainly recent history of the last decade or two has shown that they're very determined about their growth rates, but they do recognize the fractured and threatened debt structure that they face, And they do recognize, I think, as we have seen from the fact that, money rates, periodically, overnight money rates spiked in the last quarter of last year, haven't shown the same tendency to do in the recent past, which would suggest that they're kind of getting on top of solving two problems at once. I think they can. I also, if you look beyond China, certainly the European and the US manufacturing data, and we heard a lot about this slow, steady recovery this morning among the economists on that particular panel, very impressive. Certainly, without going into detail about all of the various pieces of data, it does appear as though we shouldn't take it for granted that copper prices will remain below 7,000 for too long. But in the ultimate disclaimer, I must tell you that if I really knew what prices were going to do, I wouldn't still be getting up at 3:30 in the morning to cover the London markets, and I wouldn't be stuck with this IQ of 50. I thank you very, very much for your time and attention.
Thanks very much, Michael. Thanks, Michael. Okay, thank you very much. That was great, Michael. Much appreciated.
Thank you.
Our next speaker today is Ed Meir, and I think I've got the pronunciation right on that. I get a lot of Pickard versus Picard.
Yeah.
And it doesn't really bother me.
It doesn't bother me either.
Okay, good. So Mr. Meir has been in the commodities business for about 30 years in various capacities. After getting his BA in economics from McGill University and his MBA from New York University, Mr. Meir started his career in 1980 with Drexel Burnham Lambert as an analyst covering the sugar, coffee, and cocoa markets. He spent the next 9 years in the physical markets, trading aluminum, tin, and steel for Trans World Metals, and did the same thing for another 7 years as an independent agent, where operating from London, he represented various US companies sourcing physical non-ferrous metals. In 2003, his firm was retained by MF Global as an outside commodity research consultant for base metals and for energy. In November 2011, along with the rest of the MF Global team, he moved his consultancy to International FC Stone, where he continues to provide award-winning research commentary. Mr. Meir was ranked by Metal Bulletin as the #1 overall base metals analyst in 2011 out of 30, #2 in 2013, and #3 in the overall precious metals group in 2013. Please welcome Ed back to the stage. Thanks, Ed.
Thanks very much, Joe, for your kind introduction, and thanks again for having me here at ISRI. It's always nice to come to Las Vegas, and everything stays in Las Vegas, as they say, so except this conference, which is widely broadcast. I wanted to congratulate Mike on a great presentation. I agree with many of his points. You know, as I was trying to think of what I was going to say, and I don't have a presentation to show you, so I'll just talk through some of my talking points. As I was thinking about what to say, I kind of was in the same dilemma in that there really is no clear trend on, or a clear case you can make for copper prices. You can take it either way. In fact, I heard a well-respected consultant, kind of a Cassandra, saying that prices are going to $1,500 next year, which kind of just woke me up from my stupor listening to him. But prices are all, forecasts are all over the place right now. I think, like Mike, I am kind of more on the middle ground. I think, however, if you want to figure out what's going on with copper, you have to look at the big elephant in the room, which is China. No other country comes close to impacting its price as the Chinese do, given that they buy 45% or 40% of the world's copper. So, you know, sitting here in the West, it's very hard to know what's going on over there, especially in the minds of 10 or 20 Politburo members who are pulling the strings of this huge economy. And I think they are getting into some trouble. I think they've experienced a few glitches. I think it's going to get worse before it gets better over there. with the main reason being that the Communist Party has decided on a reform package for the economy, as you know. And by definition, when you reform an economy, you have to stand back and let market forces take their sway, so to speak. So if you're reforming, if you're going to adhere to reformist principles on a macro level, and the indications are that the government is going to, in fact, stick to its plan, they have to do things like letting rates move up and down more freely. They have to let capital come in and out of the country, which means that the currency will likely appreciate if money starts going into China freely. They have to transition the economy or step back from these enormous government projects and let the consumption side of the economy take effect, which is what they want to do. Chinese consumers are still not doing their fair share in terms of contributing to GDP. Their total spending is actually less as a percentage of GDP than it was 15 years ago. And that's because the government has ramped up its spending so much that it's dragged down, or as a proportion, it's dragged down the consumption sector. Then you have things like the environment, a huge problem. How do you stop people from literally dying in these polluted cities? One way is to curtail this huge expansion of manufacturing. I read an interesting statistic that there's one city in China that has 150 steel blast furnaces. That's in one city. In all of North America, that's US, Canada, and Mexico, we have 32. So it just shows you the enormous amount of manufacturing capacity, much of it excessive in my view, that is plaguing the country. So all of these things, when you add them up, if you kind of step back and say, okay, this is what the government is going to do, it means that the economy is going to transition to a slower growth mode, more bumps along the way, and ultimately it'll become more efficient, which is what the government also wants. But in the meantime, it's going to be rocky, and you're going to get incidents like Mike was saying with the currency. It's going to have big movements. Sometimes the government will be able to control it. Other times it won't be able to. You're going to have more of these corporate defaults. We had 4 in the last month, I think, and the government did not bail any of these guys out. They sort of let the bankruptcy laws take effect, which was a new approach. So, all in all, the Chinese growth story is not a straight line higher like everybody was assuming for years on end. And I think that's going to impact copper demand to some extent, as well as commodity demand in general. Having said that, China isn't a main copper producer, unlike steel and aluminum, where it literally swamps the market. So even if it consumes less, or even if it produces less, it may not really affect the market balance that much on an aggregate basis. We'll just have to see how this growth story plays out in China. But certainly, you're not going to see big retrenchments like we expect to see in aluminum. I think aluminum is very overextended in terms of manufacturing. I think steel is very overextended. They have something like 200 million tons of excess capacity. On the aluminum side, they have enough capacity to produce all the aluminum in the world if they want to. So the numbers there are much scarier. Copper is not in the same boat. So in that sense, there is an element of support on the supply side. The question is, how will demand react? And that depends on what you think of how the government is going to navigate this reform process, which I think will be pretty bumpy, at least for this year. Let's see. In terms of some other just highlights on some numbers in the market, and Mike touched on this earlier, there is a lot of copper inventory in sort of so-called gray stocks, unaccounted for stocks. about 700 to 800,000 tons. And what's happening is a lot of Chinese companies are importing copper and using it as collateral to either get more bank lines, or they're getting it on a payment deferred basis. In other words, they don't have to pay their suppliers for 6 months or 8 months, and they're using the float, they're using the money that they get from selling, and of course they hedge the copper, but they sell the copper, get the cash, and they either invest it in short-term notes or use it for working capital, and in more fraudulent cases, they kind of repledge the collateral to several banks, and the government is cracking down on those on some of those people. But we've heard some negative stories as well on that. So that's what's happening on this financing deal, which makes things even more complicated because you don't know how much of this copper that's coming in every month is being used for financing as opposed to electric cables or power grid or air conditioning or whatever it is. It kind of disappears in the numbers, and it makes our job much harder to figure out what's going on over there. From what we hear, the government is not going to stop this practice altogether. They might regulate it a bit more. They might control it. So it tells us that copper import demand might be a bit less this year, or it'll probably match 2013 levels, and we're not expecting a huge boom in copper imports. Already the February imports were sharply lower from January. January, we saw a record high number of commodities being imported, I think in advance of the lunar holidays and some accounting and seasonal restockings. So we saw a big drop in February. March is expected to be a bit higher than February, but for the year as a whole, I don't think you're going to see big surges in copper import demand. There was this stimulus program that was also announced a week ago. I think it's about $132 billion of tax cuts and rail spending, new projects for rail lines, extensions of existing rail lines. I don't think that in itself is going to do very much in terms of boosting demand, because the amount is fairly small. Most of it was already budgeted in previous spending plans. And with these things, they usually have a one-off impact, because especially if they're not large enough, and then they kind of die out. And the best example is what we did here in 2009. We put in an $800 billion stimulus. The Chinese did the same thing. They got a bigger bang for their buck because it was a bigger portion of their GDP than ours was. But it really, stimulus spending can't replace a broad-based recovery. You need all the engines of the economy to fire away at the same time, and government spending isn't going to do it. So that's why I'm a little bit skeptical about the government being able to spend its way out of this crisis, especially if they are also intent on reforming the economy, which means that they're going to keep a tight grasp on the purse strings, and they're just not going to open up the coffers for any kind of spending that comes down the pike. So there are some inherent contradictions in terms of what we think they will do and what they are planning to do, judging by the rhetoric. Let's see. Leaving China aside, a few things that you may know already. The market is expected to be in surplus this year and again next year. And the numbers, I think Mike pointed out, the latest International Copper Study Group number, I think, was 405,000 ton surplus for this year, and it goes up to 595 next year. One reason we're expecting a bigger surplus this year than last year is because we had a lot of mine supply coming into the market from Chile, from other countries. So you had a lot of concentrates come in. You had treatment charges go down because there's more supply on the market. But these concentrates did not get smelted very easily. There were production glitches at some of the refineries, like in the Philippines. There was prolonged maintenance in some cases. Many of these concentrates were low grade, so it took time. So as a result, we saw mine supply go up a lot, but we didn't get the actual copper on the other side. Mine supply was up like 7%, and refined copper units were up only 3% last year. This year, we think it's going to be smoother sailing. We think, there'll be more concentrates coming in, and some of the refined side will also ease up a bit. So we're going to start seeing inventories perhaps start to build again, which is another negative if you're keeping tabs on the ledger, as Mike was, it's another kind of a bearish short-term phenomenon. Some interesting notes on the macro side elsewhere. I think the US is doing very well. As Mike also mentioned, we are expanding here in the housing sector. Our car sales are very good. They're almost back to pre-crisis levels. Energy production is doing extremely well. In Europe, we're finally growing. They've been in their longest slump ever. And last year was a good year, but keep in mind, growth of 1% is nothing to write home about. They still have immense problems in Europe, many of which haven't been addressed at all, including structural unemployment, tax policies that are very variable, a lack of central coordination because of the political structure that's involved. So, and of course, the banking and the high debt that many of these countries like Spain and Greece and Portugal still have to work through. So Europe is sort of on life support because of Mario Draghi's famous phrase that he will do whatever it takes, meaning that he's going to keep interest rates low and keep pumping money into the system. As David Stockman from the Reagan administration says, the stimulus of these banks is the equivalent of financial heroin. And it's a good phrase. Everyone is pumping money in and hoping that it'll spark a recovery. And it's a very dicey game because it's never been tried before. And I just don't know, as a student of economics, how it's all going to play out at the end. But it's a big gamble that all these central banks are taking. Moving on from the States and Europe, Japan is kind of in a sluggish mode. I think the growth projections are about 1.5% for Japan. Again, they are playing a different game. It's very similar to the stimulus, trying to flood the economy with money and drive the yen lower and hope that their exports will give growth a boost. That happened to some extent, but now it's starting to flag. And also when you purposely depreciate your currency, you're going to upset a lot of your neighbors, which is what's happening with the South Koreans. They're not pleased to see the yen weaken like this, especially against their currency. So it could set off a minor currency war in the region if the yen starts to fall quite quickly. In terms of the other BRICS, Brazil, Russia, India, they're certainly not growing the way they used to be several years ago. Brazil is in pretty bad shape. It has 11% interest rates, 7% inflation. Growth is practically at low single digits, something like 2%. India is doing a little bit better, but it's going through an election right now as we speak. But the growth picture there is also very slow because unlike China, things just don't happen very quickly in India. So if you want to build a road or a highway, it's going to take 15 years as opposed to 15 weeks in China. So their growth is on a sluggish path, and I don't see them kind of taking over from China in the short term in terms of more metal demand. They'll probably be pretty much stable in that category. One thing that scares me in the short term is this business with the Ukraine. It's what I think is this year's first black swan event, sort of an unexpected event. And this thing, I think, can destabilize the markets and throw everybody's forecast off if it spirals out of control. And it's certainly not ebbing. If anything, it's still out there. It's still pretty serious. Every day you read about new threats, new kinds of intimidation by the Russians. Today we read that Putin wants to charge the Ukrainians in advance for the gas purchases. He's already doubled their prices in the last week, granted from a very low base, but he's stepping up the pressure. He hasn't withdrawn the troops. I think this, I can't believe that 95% of the Crimeans voted to join. I'm a bit suspicious of those numbers, especially by the younger people who I don't think are, eager to become pro-Russian overnight, maybe the older generation. But so the thing is very unstable, and it's not a political issue, it's a metals issue, because we've seen, for example, in the case of nickel, prices have really gone up partly because of Indonesia, but partly because one of the nickel oligarchs is on the sanctions list. And all of a sudden, people are worried about nickel supply coming out of Russia. They're worried about Norilsk possibly being sanctioned. On the aluminum side, you had a huge increase in aluminum stocks on the LME, with the rumor being that one of the banks put the metal on the LME to get the cash in case the Russian aluminum would be sanctioned and delisted. So it's really impacting our markets. And you're seeing the same thing on the steel side. Ukrainian steel coming out of the Black Sea. People are not shipping it through the Black Sea. They're rerouting it through northern Russia because they don't want it to accumulate at the ports and possibly get stuck overnight. So this is a variable to watch, and I hope that it'll kind of fade away, but I don't get a good feeling about it just looking at it from a long distance. In terms of our price forecasts, again, like Mike, I'm kind of caught in between two sides. I think on the bullish side, perversely, I'm much more constructive on some of the other metals, like aluminum, nickel, lead, zinc. They're all in deficit. And what we might see happening is a rally in these other metals might be what could possibly spark up copper. So whereas copper was always leading the group, we might see the other metals perform better and possibly lift copper as well. Although this certainly hasn't happened today. Everything was up today except copper was down. By the way, I think copper was down today because there is this CESCO conference in Chile, and all these CEOs of these mining companies are saying how good the production outlook is going into 2014. Not all of them, most of them. So I think that's kind of given the market a bit of a wake-up call. I think you would agree with that. And that kind of explains why we sold off, whereas all the other metals went higher. But back to my earlier point, we might see copper stabilize and be pulled higher by some of these other metals that I think are on the mend. Another constructive reason is, Chinese demand, while it's down, is still quite sizable. It's not going to zero. It's still, the big component. So if you don't import 500,000 tons a month, you'll import 400,000, which is nothing to sneeze at either, even 300,000. It's still pretty sizable. And the government will continue to, it's not going to get out of the spending business overnight. They still have lots of cities to build. Granted, half of them are probably empty, but they still are building them, more highways, more bridges, and that's going to involve a lot of copper. One item that I found was interesting was there was a Chinese electric cable manufacturer that was saying the Chinese are using very little aluminum in their electric cables. And that could be a bearish factor because if the electric cable manufacturers start using more aluminum like we are in the States, apparently 50% of the electric cables have aluminum alloys here in the States. In Europe, it's about 60%. In South Korea, it's about 70%. In China, I don't know what the percentage is, but it's nowhere near that. So given the gap between aluminum and copper, that could be kind of a long-term negative for copper demand for China, something to watch and something I wasn't really aware of until I read it. Finally, I'll leave you with our price forecasts, if I can find them. I think we are looking at I think we're looking a little bit lower on prices for 2014. We're looking at a possible retest. The low so far has been 6,300. I think it's possible we could get to about 6,100 sometime over the course of 2014. That's basis 3 months on the LME. On the high side, I think we could rally to about 7,500. That's a big range, but given these markets, it's certainly possible, especially if you get fund activity back in. Mike mentioned the funds briefly. What we see happening is funds have been leaving commodities in droves over the last few years because the action just hasn't been in our space. It's been in the equity markets where, you know, S&P was up 30% last year. So everyone is piling into equities, and nobody's in commodities, especially when they're kind of flatlining. So I think that could change. I think markets are poised to push higher end of this year and going into 2015. I think after 3 years of bear markets, things are about to turn, mainly because of the supply-demand deficits that we see coming, not so much in copper's case, but certainly in some of the others. And that, I think, will get some more of these funds to look at commodities more closely. By the way, one thing that might be good for you guys to look at, and feel free to drop me a card, we could email you this information. Reuters always puts out consensus forecasts on where analysts think prices are going. So they give you numbers for 2014, 2015. So instead of taking my number or anybody else's number for your basis, you can put in the Reuters consensus average and use that for budgeting or modeling. We find that very useful, and a lot of our clients appreciate it when we send it to them. So I'll be happy to do that if you're so inclined. The next set of numbers comes out in about 2 weeks, and I'm sure there'll be major adjustments from the first time. It was out in January. I also write a research commentary every day on the metal markets. If you'd like to be on our list for a period of time, we'd be happy to put you on. You could drop a card off with me after the session. I think that's about it.
Thank you, Ed. Thanks very much. Well, we now have some time for Q&A. We invite you to come up and ask a question, anything you've got. We've got 2 microphones set up here in the front of the room, and we'd be more than happy to take any questions that you might have. We might have a taker already in the form of Mark Lewin.
Oh,
Mark.
right, that's quick.
All right. Question I have for you, I'm going to preface with a comment. I'd like to go back to the financing in China and the use of copper in it. The comment that I would make is that it's not only limited to cathode copper. They're also using scrap. And as we've seen over the last probably month, I'm going to say, as the copper market fell back, the spreads between exchange prices and scrap prices didn't really change. And what we heard is that scrap that was being used as collateral or as the finance option there in China, that was being moved from warehouses into the smelters there in China and actually being consumed. There was a little brief period where somebody had lowered their discount, but that quickly went back. Can you walk us through a little bit better some of what the financing means And do you see much of that going forward in the future?
I'll go first, and Mike can add certainly. I've heard as well that the Chinese are using things like copper, iron ore, cotton to do a lot of these financing. I haven't heard scrap being the preferred medium as much because, if they're buying some of this metal with the idea that they need to pay their supplier back down the road, they'll have to hedge it in some way. And hedging copper is a much cleaner proposition than the hedging scrap. So I don't see it happening. I don't follow the flow, so to speak, in terms of what could happen. We heard when the refined prices dropped a lot on the LME, we heard a lot of cancellations took place on some scrap into China, and also some scrap that already was in China or en route to China, and a few U.S. traders apparently got stuck with the usual cancellation in light of falling prices. That's what I heard. I didn't hear of any sort of blowback on the financing side. We did hear that, interestingly, the two prices that fell the most once these defaults hit the press were copper and iron ore. They both fell that same week very sharply. And that suggests to me that copper is much more in play than scrap is, which, according to what you're telling me, didn't really move much in terms of the discount. Hope that helps.
Michael, did you have anything you wanted to add?
No, I was just going to underscore what Ed said, and obviously one looks very carefully at proliferating bankruptcies and whether they actually cross the Pacific. We've heard of a possible case so far, but I think Ed's exactly right that, and these are things that we look at and the things that we're asked for, not specifically in China, but it's a lot, from a mechanical point of view, it is a lot easier to collateralize a deliverable, exchange deliverable entity than one that isn't. So I don't have quite the depth of insight as Ed would have in this case, but it would be a very complicated transaction without the ability to deliver, if need be, to the exchange at a moment's notice.
I agree.
Thanks for that. Mr. Heitmeyer?
Well, my question is also regarding China, and I heard in the speeches that we're talking about, specifically regarding China, corporate defaults, commercial or government housing projects that no one is living in China. There's second mortgages and limiting. And how does this affect copper? And is it not eerily similar to the U.S. Situation in 2008?
Thanks, Matt.
Go ahead.
It is. I mean, it is, but some caveats. First of all, from what I read, many of these apartments have been bought. Although no one is living in them, somebody has bought them. And they're basically investments with, the greater fool theory. Somebody will pay more for it next week or next month. The problem is what happens when prices stop going up. And in fact, many cities, they've stopped going up and they're coming down. This is something the government can't really control. It's a real problem. I think the biggest threat for the Chinese economy is if real estate prices start coming down. I think that'll just start a domino. But having said that, there isn't going to be massive defaults because the Chinese usually pay for these apartments up to more than 50% in cash, sometimes all of it in cash. And so they don't have second and third mortgages. They don't have these no-income checks like we had during the crazy times. So I think they have much more skin in the game. But that doesn't mean prices could still fall. Just because you don't have a mortgage doesn't mean you could be wrong on real estate. So I think it's a problem. And I think these ghost cities are also, I scratch my head because it's just an amazing experiment to physically move 300 million people over, I don't know, the next 7 or 8 years away from the country to these cities relocate them. And I ask myself, what are these people going to be doing? I don't know what they'll be doing in these cities. Yes, they'll have some money from the sale of their land or their farms or whatever it is, but I just don't see what the end game is in terms of what these people will be doing as they're being forced to move.
They'll be recycling copper. No. Any other questions from the field? Or Michael, did you have anything you wanted to add?
No, I'm also fascinated and have been for a long time as somebody who was perhaps early, maybe premature is a better word, in terms of trading with mainland China some decades ago. I'm also very fascinated by the ability or otherwise to transfer rural populations to urban activity. And while the question that was asked bears some resemblances, I would just go back to what I said a little earlier. And perhaps I have a little more, sounds as though I have a little more faith in the structured approach of the Chinese central authorities than Ed has. I'm sure Ed will prove to be right. I think that the resemblance to 2008 is there in terms of economic infrastructure, but not necessarily in the ways that it gets dealt with. I think there is a separation that sets in there.
Thanks very much for that. And I would invite anyone who has a question, please do feel free to come up to the microphone to ask these gentlemen whatever questions might be on your mind. Just sticking with China for a moment, it's hard to overestimate just how important China is, certainly for exporters of scrap from the U.S. I mean, last year, in terms of U.S. copper scrap exports from the U.S., about 78% of that went to China or to Hong Kong.
Right.
So it's just a huge influence on the marketplace here, the copper scrap marketplace as well. And just thinking about sort of the substitutability that the Chinese have between the ore, the concentrates, refined copper, and copper scrap. I think traditionally, as we've seen copper prices come up, refined copper prices come off, that tends to make copper scrap less attractive because the refined is a little bit, as it becomes less expensive, it's more attractive for the Chinese to use. Based on what you're expecting in terms of prices, and I'd like to firm that down a little bit more on pricing, right. What implications do you think that would have in terms of using scrap versus refined versus concentrates?
Yeah, it's a good question. I don't really know the answer in terms of, I'm not that familiar with the dynamics as maybe some of the audience would be that are involved in trading it. But the numbers are showing that scrap seems to be holding up. The imports are haven't really collapsed. The refined imports are jumping around a lot, but we really, a lot of it is seasonal because of the New Year and all that. So I think the short answer is we need to see a bit more data come in before we kind of get a better sense of the relationship between the two. Okay. The scrap traders I've talked to in the UK who do a lot of business with China are telling me that things are still very, very slow, that demand is still very sluggish. And yet the figures don't show a really big drop in the scrap side. It's all very murky. Right. You have the financing, you have the scrap, you have the real consumers, you have the arbitrage, people bringing in refined and then shipping it out again. You have the fact that there are duties in there. So it's not an easy thing to get your arms around. Right. But I'd love to hear anybody else's take on it, especially those who are dealing with China on a weekly basis.
What adds perhaps to the murkiness is that Ed's data is a lot more reliable than the Chinese data. Well, we've seen that happen as well, and I think that Ed is right. It's a very murky picture. It is one that I can't address specifically the scrap substitutability because I think there are much more qualified people in our audience. But Ed's absolutely right. There are so many, we've tended to focus today on socioeconomic factors, particularly as they pertain in China. And there's no reason we should minimize that. We should be emphasizing that. But as Ed quite rightly pointed out, then comes along Mr. Putin and he decides he wants to restore, the former glory of the Soviet Union. And he wants to reclaim the breadbasket in Ukraine and the deep sea ports for his naval forces and whatever else. And yes, I think Ed's data is also more reliable than the election statistics in fact, far more reliable than the election statistics from Crimea. So it is a very, I think probably, I don't want to speak for Ed, but perhaps I can in this case, I think we'd feel a lot more comfortable coming up before you with a much more clear-cut picture. But I think both of us did, present a series of factors that could influence the market higher and lower. I think Ed's probably leaning a little more than I am, towards the downside, and he will probably be right about that. It is also true, not to undermine, what happens in this meeting, that, you could go out and put your chip on red and, probably stand as good a chance. But it is a time when it's very difficult to formulate definitive opinions. Its wider market has been somewhat, as Ed mentioned very importantly, has been somewhat trendless, over the last couple of years. And and it's chicken and egg, I know, and I'm never quite sure what comes first, but there's been this fund exodus from the commodities arena.
Mike, I'm curious, from your dealings with, I assume you have some Chinese clients,
Yes.
What are you kind of hearing from the field over there?
Well, as I said, it's a little bit of a mixed bag over there as well, but one senses certainly a heightened degree of pessimism. I'm always a little bit of a stubborn, contrary opinion philosopher when it comes to this. So the more people who are bearish, more likely it is to go higher, even including our friends at Cesco, by the way, and that was very well taken point. But we have, without in any way contravening any customer confidentiality, we have seen a bigger leaning of Chinese-dominated funds towards the short side of the market than we have seen in a long time. Will they be right or wrong? Again, I don't know. But certainly we have seen, and that, that's over the last couple of months, and surprised us a little bit, honestly. But those are the flows that one sees and that are impacting the market for sure.
Right. Sticking with investment flows, I mean, keeping in mind what you just said, what do you think would actually attract the investment community back into the commodity space and copper in particular? I mean, we've seen stock markets do, incredibly well. Commodities not close to that kind of performance. What do you think could possibly tip the scales back in commodities' favor? Anything?
Well, I think investor flows really follow markets that are trending. So we need a spark in the commodity markets, and we need, we don't need a pronounced bear market because people don't like to buy things. People usually like to buy things. So they like to buy things when things are going up. So we need plagues, earthquakes, floods, geopolitical wars, anything like that, deficits, doom and gloom types of things to get everybody back into our markets, which is kind of what we had in 2004, 2006 with China just coming in so strong on the buy side, and that dovetailed with all the funds coming into commodities at the same time. So you had this combination of events that just took prices to just astronomical levels. Certainly beyond anything I could have ever imagined.
That's very interesting what Ez said, because all of those depressing factors are probably, what is required for copper, but also what's required, and I say this generically about metals, but specifically we're in a copper session, is that I think over time, and again, I don't know exactly when there'll be a natural rebalancing process.
Correct.
That those who have ridden the equity markets very, very successfully over the last few years, perhaps that will start to falter, and they will start looking. At the moment, they're very comfortable, they're very secure. Something will come along, perhaps one of Ed's black swan events, will come along and create this natural dynamic of rebalancing where those investors will say, we've had a good run. Where haven't we had a good run recently? What is depressed? As Ed said, they like to buy things. What can we buy that has some upside potential? So part of it is copper, no question. Part of it is the dynamic of the other outside markets, and that will change.
Sure.
So pray for a natural disaster.
Yes. Nobody getting hurt.
Of course.
Yeah.
Mr. Garino?
Well, sort of related to what you guys have just been talking about, a natural occurrence could be the introduction of a copper ETF. We saw what happened in 2012 when BlackRock and JP Morgan were very close to launching an ETF on copper. I guess the question is, do you see that back on the table? Because you said, the commodities are poised for maybe some reinvestment by the investment community. And I guess the second part is, what do you think that would do to copper prices?
Yeah. I think it's a little bit the other way around. I think once copper prices start to move, or some of the other metals for that matter, then the ETFs will come in. I don't think just because you have an ETF, people are going to start buying it, because again, they're going to have the same problem. They buy the ETF and it just stays there for 2 months and erodes because you have the cost of rolling this position in a contango or even a flat market. So I think it's hard to get people excited about the individual product when the underlying price is just not doing very much. And we're seeing that very clearly in gold. Everybody was buying the gold ETFs, including John Paulson and all these other fund managers. They all piled in, drove up the gold price, and then they all exited on the way down. And so if you bring out another gold ETF now, it's just going to fall flat. I'm not sure what JP Morgan is doing with its ETF. I think it's delayed, but I'm sure it'll come in. The banks will always have new products to put out. I'm sure one of these days we'll see it, but I don't think it'll gain the traction till prices go up. In the meantime, you can buy other things as proxies. You can buy some baskets, you can buy the mining stocks, you can buy, Alcoa has been a very good mover with aluminum prices. That stock has more than doubled in the last year. So there are plays without the market crying out for an ETF.
Yeah, I would tend to agree just briefly with Ed. It all comes down to, why didn't it take off in the first place?
Right.
And it was just simple, lack of attractiveness. I think lack of attractiveness, there's probably two components to. One is that the market just wasn't attractive. And I think at that time also that copper didn't have the allure that gold has. That could change, as I said, that could change in the future. But thus far, we haven't seen, and from where I sit, I haven't seen people clamoring for that type of investment.
Thanks for that. I did have a question. It was of interest that I saw with the Michael Lewis book on the high-frequency trading, and heard some of his interviews. Most of the headlines would say, stock market's rigged. And thinking about copper trading and the volumes that are traded today, can the copper market become rigged? Is that a possibility? Or is it already?
First of all, in deference to our lawyer sitting in the front row, I'd prefer that we don't use the R word, if you're all right with that. I I'll be a little bit circumspect. I did touch on it in my presentation for a reason, so I'm glad it provoked a reaction. Because, as I said, and this will be ultimately in the hands of those more qualified to analyze, be it regulatory bodies. I heard the FBI got interested as a consequence of Michael Lewis. That's not for me to say. You know, we service whatever customers we have in whatever way we can. But there is already a significant percentage of high-frequency participation in our markets. I'd rather not be pressed as to what I think that percentage is, but maybe if you come up quietly afterwards, I'll talk to you about it, given again the presence. But I would say that shouldn't be news to anybody, because at the end of the day, when it comes to high-frequency trading, it's all about price. It's all about the ability to achieve a particular objective a nanosecond ahead of somebody else. And it really doesn't matter if it's copper or equities or soybeans or whatever. That doesn't make a difference. So if the question is that already a factor in our market? It is. I think that there are those among us, again, I shall be a little bit cautious here, who are concerned at what precipitates a high-frequency trade.
Yeah. I think one of the things that stands the LME in good stead is the ring. It's very hard to manipulate orders coming through the ring because it's an open outcry system. People are watched. They literally have to touch the couch when they're, one of the quirks, British quirks, have to be touching the couch when they say something, right?
Barely, but yes.
Barely. So there is an element of openness and sort of honesty and good form in the ring. So I think that serves it well.
Ed's point's very well taken in terms of, you know, transparency and equal ability to participate. What I think will be interesting in years to come, and if you ever have us back, and I'm sure we'd both be delighted to be back, but if you ever have us back, will be to see how these trends in terms of trading vehicles play out. You know, to what extent will there still be open outcry trading? Will electronic platforms become too infestated? I think that's a word I can use. Too infestated with, you know, high-frequency traders to really be a platform for hedgers and investors to get price-efficient liquidity. You know, will we rely ultimately, and we see this trend honestly already commencing from where I sit, you know, of customers looking basically when they have large volume to do, looking to do what perhaps in other markets would be called block trades, and then it's the ability of your broker and or bank, you know, to source that liquidity perhaps from other customers or other liquidity providers. So we're in a very unsettled stage, not only in terms of forecasting copper prices, but also we're seeing a lot of changes, and we will see a lot of changes in how we trade. And this is still ongoing and developing, and it will be very interesting to see. The LME itself actually has a standstill clause in the original purchase agreement by the Hong Kong Exchange to January 2015. One senses that they'll go beyond that, but there are certainly questions that arise. And some of those questions are not necessarily functions of the exchange alone, but they're functions of the liquidity that the exchanges receive. To give you an example, there is unquestionable decline in liquidity from banks who have been regulated virtually out of, we saw that with the recent exit of Deutsche Bank, in entirety from a major commodities role in the market, have been regulated out, you know, from providing that type of liquidity. My sense is you have to be careful what you wish for, because sometimes that liquidity gets transferred into as do warehouses, by the way, into more opaque and less regulated hands than what you had in the first place. So that's going to be very interesting to see how that all plays out in the coming years.
I agree.
Well, I've got many more questions, but unfortunately we're out of time today. It's been a great discussion. Thank you both so much for joining us today. We would be delighted to have you back in future events. Thank you very much. Thank you.